FBN Capital released a report on the Nigerian banking sector, highlighting the earnings growth momentum in the first half of the year, and they also note that certain banks are on course to deliver return on average equity expansion of around 15% in 2012 to about 18.8%. Joining us on the line right now is Olubunmi Asaolu. He's the head of research at FBN Capital. He joins us on the line from London. Olubunmi, it's great to have you on the show today. And first of all, I want to get your perspective on the first half results. Clearly, you are pointing to very strong earnings momentum recovery there. But can you just point to us, for you, the key takeaways of what is driving that earnings growth momentum?
Thanks very much. Good morning. Just to reiterate part of what we said coming to this start of 2012, a lot of the earnings momentum we've seen in the first half is really driven by improved asset quality ending 2011, coming to 2012. So we show in the report how the NPL ratios have steadily declined from 2009, 10, 11, and if you look at the average for the sector as of June, the NPL ratio is about 5%. On top of that, you have IFRS accounting, which combined with the NPL ratio reduction I've talked about, tend to lead you to reporting basically lower provisions year on year. So those things have combined to help the banks report very strong H1 earnings.
All right. And in the second half, what are your broad expectations for the sector?
We still think that you see the same thing in second half. Now, I mean, that sounds like a sort of easy answer, but I mean, it's a fact. The banks may not be lending aggressively because if you look at the month-to-month figures, it's not running away in any way, shape, or form. But the massive liquidity that quite a few of them still have is helping them report steady to slightly improving earnings on a Q-on-Q basis through the rest of 2012. So we still see some momentum left for this year. Next year is going to be a bit more difficult because the comparables on a year-on-year basis are going to be tougher.
Right, I was going to come to that. And clearly, this year has been fantastic for the sector. We've seen the sector run away, leading the broader market. From the companies you track, year-to-date performance for the banking sector is 31% compared to 22% for the NSE. So very good growth in the share prices, reflecting the earnings growth. But for me, this points to the fact that we are coming from a low base. Clearly, 2011, 2010, we've seen NPL issues for the sector. Going into 2013, and what kind of growth rates can we anticipate?
Yeah, I think maybe I could take you back a little bit. I think at the start of 2012, there were many doubters out there. So regardless of what you say about NPL ratios coming down, the market just didn't want to believe that much. I mean, if you look at Access, UBA, and Diamond, which have basically topped the table this year, I remember going around in Q4 last year and Q1 this year, drumming on the message that it's time to load up on some of these banks. The market just didn't want to believe until it saw some evidence. And even in Q1, you still saw what appeared to be a false start. So I think we're stressing again now that there is still upside left in some of these banks. I mean, Diamond may have gone up almost 70-80% this year, but it's still trading on 0.5 times book. So I mean, we see upside to something like 6.7%. I was arguing with an investor yesterday whose views that a Diamond will get to 10 naira. Now, we may not have the fundamentals to support that, but from current levels, we see doubling still.
All right. A quick note on risks going forward. What's the risk to the outlook? We're seeing headlines like UBA may be stressed by its exposure to Air Nigeria. Those kind of headlines obviously giving some people concern. And with the power sector growth expected this year, the banks are expected to be exposed to that, and some people are worried that if the privatization doesn't work out as planned, we may see some new NPLs as a result of this.
I think I'll do the second one first. The power sector exposure of the banking sector is tiny. It's less than 5%. So even if there is some risk there, it's more on the lending side than on the NPL side, i.e. growth-wise. So we're not too concerned. It just means a bit of a push or delay into the future. On the headline risk, I mean, we try and address this a lot in the report as well. So downstream oil and gas, as well as, I guess, Air Nigeria. Now, on the downstream oil and gas point, most the headlines sometimes give people a sense of pessimism. So banks' exposure to oil and gas includes upstream. Now, if you delve into the downstream part of that exposure, you get maybe on average probably 10%. And we have a table in the report that shows this as well. Now, of that exposure, you'd be surprised to find that the likes of Diamond and UBA, which in the past would have topped that table, have very tiny exposures to downstream. UBA is 1%. Now, we then go further and say, of the companies that these guys lend to downstream, which ones are the most at risk that the headlines seem to be grabbing all the attention? And these are the, 25 companies in the special investigation report that was released recently. Now, of those 25, you'd find that most of the banks, at least the ones we cover, the major banks, the exposure to them is not significant. So if I take Skybank, for example, Skybank has a 20% exposure to the oil and gas sector, 4% exposure to the downstream, and it's only exposed to just one of the 25 companies. So I think people should try and delve into the exposure to the most at-risk names first.
Okay, I get the sense what you're saying is that there's not too much to be worried about at this stage, but unfortunately we can't take it further. Hopefully we'll speak to you some other time. Thank you so much, Olubunmi Asaolu, giving us a perspective on the banking sector.